Picture this. You own an apartment in Denver. 2 years ago, you listed a unit and had 3 applications within 48 hours. Today, that same apartment sits empty for 6 weeks. You drop the price, still nothing. So you offer the first month free, and when someone finally signs, the rent you close at is nearly 7% below what you were charging last year. This isn't an isolated story. This is a pattern, and that pattern is spreading across 8 American markets with a precision that economists call supply-demand adjustment, but that in practice functions like a slow bleeding of investment returns. The American rental market is going through a quiet transition, not a sudden collapse, a structural erosion. And it started exactly where everyone was looking the other way, in the markets that grew the most during the pandemic. Before we go city by city, you need to understand what changed on the macro board. Between 2020 and 2022, developers and institutional investors made massive bets on Sunbelt markets: Florida, Texas, Arizona, Colorado. The logic was simple: accelerated migration, remote work freeing people from northern cities, and cheap money. Construction financing rates were near zero, so they built a lot. Then the Federal Reserve launched its most aggressive rate hike cycle in decades. Mortgage rates climbed from 3% to over 7%. The cost of capital exploded, and now, in 2025 and 2026, those hundreds of thousands of new units are being delivered into markets where demand no longer grows at the same pace. The equation flipped. The renter gained power, the landlord lost margin, and the investor who bought at the peak is now staring at the numbers and calculating the exit point. That, by itself, is the trigger for everything I'm about to show you. Number 8. Houston, Texas. Houston has always been resilient. Oil, healthcare, logistics, a diversified economy that historically absorbed shocks better than its neighbors. But Houston has a problem that few people were monitoring. It never stopped building. The city has no traditional zoning, which means developers have near unlimited freedom to add supply, and they did. In 2024 and 2025, more than 30,000 new apartment units arrived in the metro market. The result was predictable. Rents fell roughly 3% year over year, and vacancy rates are climbing in neighborhoods that used to have waiting lists. The specific risk in Houston isn't recession, it's structural oversupply in a market with no regulatory brakes. Every new complex that opens puts pressure on its neighbors, forcing concessions, rent credits, and free periods. The rational tenant is taking advantage. The landlord is absorbing the cost, and the investor, running the numbers, sees a cap rate that no longer justifies the original purchase price. That's where the pressure begins, quietly in the spreadsheet, before it ever shows up in the headlines. Number 7. St. Louis, Missouri. St. Louis represents an entirely different kind of risk. This isn't a market that overbuilt, it's the opposite, a market that never had a major boom, but is now carrying the weight of a stagnant demographic base and an economic foundation that failed to attract the wave of remote work migrants that transformed other cities. Rents have fallen roughly 3.4% year over year, a number that sounds modest until you realize that St. Louis was already a low-cost market. When an affordable market starts declining, the problem is absorption. Landlords have less margin to cut. The primary risk here is a liquidity trap. Properties in St. Louis that were purchased as cash flow assets are starting to operate in the red, and the institutional buyer who might otherwise absorb these assets simply has no interest in this market. The cascade effect begins when the small landlord, the individual with 2 or 3 properties, decides it's no longer worth holding and lists everything simultaneously. That simultaneous supply shock is what resets comparables across entire zip codes, and once comparables reset, every property in the area reprices, slowly, irreversibly. Number 6. Phoenix, Arizona. Phoenix was the darling of the pandemic boom, people leaving California with equity in their pockets, buying and renting above asking price, pushing valuations upward as if there were no ceiling.
But Phoenix has a characteristic that makes it especially vulnerable right now: a high concentration of institutional and individual investors in the single-family rental market. When large players like major SFR funds start recalculating cap rates, they don't sell quietly, they sell in volume. And when institutional properties hit the market simultaneously, they redefine the comparables for an entire region. Rents have already pulled back roughly 3.5% year over year, and the pressure continues. The local buyer looks at the sale price, calculates the cost of financing at today's rates, a very different number from the 3% that people locked in during 2021, and decides to rent instead. That buyer hesitation feeds back into downward pressure on landlords. The monthly payment wall is simply too high, and until rates move meaningfully, that wall doesn't come down.
Number 5. Tampa, Florida. Tampa spent 5 years being sold as the affordable alternative within Florida. It worked so well that it stopped being affordable, and now it faces pressure from 3 directions simultaneously: a wave of new units being delivered, surging property insurance costs that are squeezing smaller landlords out of profitability, and a deceleration in the flow of new residents from the Northeast. Rents have fallen roughly 3.3% year over year, but vacancy is climbing faster than the headline number suggests. Entire corridors have competing complexes targeting the exact same tenant profile: young professional, median income, preference for modern amenities. When every building has a pool, a gym, and a co-working space, no one has a competitive advantage. The only differentiator left is price, and everyone is cutting at the same time. That's the dynamic that turns a 3% decline into a 6% decline over the next 12 months. Not a single dramatic event, but hundreds of individual pricing decisions all moving in the same direction simultaneously.
Number 4. Miami, Florida. Miami deserves its own entry because the risk here is paradoxical. It's an expensive market that should be resilient, and in parts, it still is. But the narrative of Miami as a global wealth destination has obscured a fundamental problem. The local middle class is being priced out, and the flow of high net worth new arrivals that sustained valuations over the last few years is beginning to slow. Rents have also fallen roughly 3.3% year over year, a small percentage but a large signal when you consider that we're talking about one of the most inflated markets in America. The specific risk in Miami is the disconnect between property prices and local purchasing power. When the average tenant is spending more than 50% of income on rent, any shock, a layoff, reduced hours, a job change, produces immediate vacancy. And vacancy in Miami is expensive for the landlord for obvious reasons: maintenance costs, sky-high insurance premiums, and HOA fees that keep climbing regardless of market conditions. The psychology of the Miami tenant is shifting. They know they have options now, and that knowledge alone changes how negotiations unfold.
Number 3. Dallas, Texas. Dallas made a significant bet on the permanent return of office work in Class A downtown towers. Part of that bet hasn't materialized the way planners hoped. Many companies adopted hybrid models, and that directly impacts where people choose to live and how much they're willing to pay for proximity to a commute they only make 2 or 3 days a week. Rents have fallen roughly 3.6% year over year, with days on market increasing consistently in suburbs built around the office worker profile. But the primary risk in Dallas is something more structural: an oversaturation of nearly identical properties. Large residential corridors developed over the last 5 years feature dozens of complexes with nearly matching floor plans, the same target tenant demographic, and pricing strategies that are now cannibalizing each other. When a prospective tenant can choose between 12 buildings within a 2-mile radius that are essentially interchangeable, the landlord who refuses to offer concessions simply loses. The one who offers a month free and a lower base rent wins and forces everyone else to follow. The comparables reset is happening in slow motion in Dallas, but it's happening.
Number 2. Denver, Colorado. Among major American metros,
Denver recorded one of the steepest rental declines in this cycle, roughly 6.9% year over year, and the reason is structural in a way that makes recovery slower than most people expect. Denver attracted a wave of tech sector workers during the pandemic, people leaving San Francisco and Seattle in search of quality of life at a more reasonable cost. It worked, until mass layoffs across the technology sector began. Companies cut headcount, revoked remote work policies, and part of that high-income tenant profile simply left, back to California or to smaller markets entirely. What remained was growing vacancy in units that had been priced for an income demographic that no longer exists in sufficient numbers. Days on market increased, price reductions became routine. Landlords who bought expecting continued appreciation are now calculating how long they can sustain negative cash flow before the exit becomes necessary. And when that exit calculation tips, when holding becomes more painful than selling, supply hits the market fast. Denver is approaching that inflection point in pockets across the metro. The tenant who stays knows exactly how much leverage they have, and they're using it. Number 1, Austin, Texas. If there is one market where every signal converges to the same point, it is Austin. And the story of Austin is, in many ways, a story of narrative excess. The city was sold as the new Silicon Valley, as the inevitable destination of American technology, as the place where the next generation of innovation would unfold. Tesla, Oracle, Apple, Dell. The expansion announcements were real. The migration was real. The enthusiasm was real. And developers responded the way developers always respond to real enthusiasm, by building aggressively, ahead of demand confirming itself at sufficient scale. Imagine a software engineer who relocated to Austin in 2022, drawn by a remote work offer from a San Francisco-based company. He was paying $2,400 a month for a modern apartment in East Austin. In 2024, the company announced mandatory return to office in San Francisco, not in Austin. The local team was reduced, he went back to California. The apartment sat empty for 3 months before the landlord accepted $1,950 a month with 2 months of free rent. That scenario repeated itself across hundreds of units simultaneously. Austin today has vacancy rates above 13% in certain submarkets. Rents have fallen between 7 and 8% year over year, numbers that aren't marginal correction, they're trend reversal. The average sale price of investment properties is still high enough that the math doesn't work for a buyer financing at current rates. So the market is locked from both ends: landlords who can't sell without realizing a loss, and tenants who have negotiating power they haven't had in 3 years. What makes Austin the number 1 on this list isn't just the magnitude of the decline, it's the combination of factors feeding each other. Oversupply of new units still arriving through 2025 and 2026, partial exodus of tech workers, a cost of living that remains too high to generate sufficient organic local demand, and a market psychology that is measurably shifted. The renter in Austin today knows they have the advantage. They negotiate, they ask for concessions, they compare 3 or 4 options before signing anything. And the landlord who once received a full-price application is now calculating which concession is acceptable to avoid carrying another month of vacancy. The correction in Austin won't look like a sudden price drop that makes headlines overnight. It will look like a long winter of declining returns, lengthening days on market, and a slow repricing of what these assets are actually worth in a higher rate, softer demand environment. Structural, quiet, and for anyone still running the old assumptions, expensive.
What all 8 of these markets share isn't collapse, it's a shift in power. For a long time, the landlord dictated the market. Today, in 8 American states, the renter is reclaiming leverage, and that changes the behavior of every player at the same time. Investors sell first when they recognize the cycle is turned. Individual landlords begin offering credits they would never have offered before. And the potential buyer, the one sitting on the fence between buying and renting, looks at the monthly payment on a mortgage at 7%, looks at the concessions available in the rental market, and decides to wait. That collective waiting is what sustains downward pressure on prices. And as long as new units keep being delivered into markets already carrying elevated vacancy, the math doesn't favor a quick recovery. Here's the question I want to leave you with. If you have a friend or family member seriously considering buying an investment property in any of these markets in the next 6 months, what would you tell them based on what you just saw here? Drop your answer in the comments. That's the conversation that matters most on this channel. If you're not subscribed yet, do it now, because the next videos are going to go deeper into specific markets, neighborhood by neighborhood, with data that most investors aren't looking at yet. And if you know someone evaluating a buy or sell decision in the next few months, share this video with them. It might be the most valuable information they receive before making a 6-figure decision.